right, so on this episode, we've got Matthew Albritton of Valor Financial Planning, and then he is also, you're on the board at the Young Professionals, correct?
I am.
Okay, of Johnson City. Well, let's go on the personal finance side. First, I want to talk about Valor, but then if you want to, I'd like to get into a little bit about like financial planning. I did a little bit of that in college, but it was one of the pyramid scheme companies. And I won't say which one. I learned a lot, but I also have some issues with how life insurance and stuff is done. I don't know if you want to go there or if you just want to go more on the investment side. But anyway, before we get into all of that, let's start off with what exactly is Valor and just give us a little bit about yourself.
Yeah. So I've got my logo here in the background and my firm, Valor Financial Planning. Um, I launched in July of 2024. That's when I started taking clients. Um, and I had some core principles that I wanted my firm to follow, and that was to be a fee only firm. Um, and so what that means is I don't sell any commissionable products. I don't do anything with mutual funds. I don't have any incentives to push any financial products at all. I don't sell life insurance. I do plan around life insurance and have those conversations with my clients. And I think we'll talk about life insurance a little later. But fee only, I see a large push in the industry to go that direction. There's also fee based, which means you may sell mutual funds, you may sell insurance, but you also do some more of the advisory work. And then you have the other end where the only way that the financial advisor makes money is fully commission. They have to sell you insurance. They have to sell. They're going to put your investments in mutual funds because there's a sales charge, and there's account fees and all of these little hidden fees that the clients don't know about. And to be clear here, I can really go into detail on these things. So if I'm just going too deep, like pull me out a little bit and say, hey, it's too much. But
No, I think it's good because most people with personal finance, I mean, like we get, our employer or whatever ever will offer us a 401k, and then they're like, oh, there's like a life insurance guy coming in, but it's all in these little silos. And
yeah,
then it seems like life insurance people always want to sell you whole life or this or that. So anyway, we don't. I think the more we go into it's better.
yeah. So I started out in the financial industry at a portfolio management and investment research RIA, and it was really good experience to learn the investment side of the business, but also to get exposure to what it looked like to interact with fee only advisors. So I knew that long term that I never wanted to go work somewhere um, where to put food on the table, I had to sell clients insurance products that may not have made sense for them in that season of life. Um, and so from there, I knew that I wanted to actually get into financial planning. So I went and worked at a firm. It didn't work out there. That firm wanted to grow initially, and then 9 months in, they decided they didn't want to grow. So for me, I had to make that choice, go work somewhere else where, again, there might be tensions as far as values not aligning. And so I just decided to launch my own firm in the middle of April and started that process. From July, when I started taking clients, to now, I serve 28 households. And every one of those households, it's different conversations, it's different, scenarios that I work on with them, from a comprehensive financial planning standpoint. So I'm also working on my CFP, that's Certified Financial Planner, sort of the gold standard in the financial planning industry. I will test for that in November, and hopefully when 2026 rolls around, I will be a CFP. So I think that's a big value add for me, for my clients. As a CFP, you're held to a higher standard in how you present information, how you gather information, how you're able to interact with your clients. The cool thing that as a registered investment advisor, and you'll hear me say RIA a lot, My firm serves as a fiduciary for my clients. I serve as a fiduciary. And what that means is that I always have to have the client's best interest in mind. And that could mean sometimes I send a client away because I can't serve them, in the best way. So fiduciary is, we call it the F word in the industry. It gets thrown around a lot. And so I believe that for any client to sit down with a financial advisor, they should be asking some very important questions. How are you compensated? Are you a fiduciary for me, or are you a fiduciary for the company you work for? So some advisors can say, yes, I'm a fiduciary, but guess what? They're working in the best interest of their company, not the client they're sitting across from. So I don't really hold my punches back on how the industry works, and am very quick to point out where there are scenarios where I think a client is being taken advantage of. So yeah, that's a little bit about how my firm operates, why I decided to go fee only. And we can go into more detail on any of those things, but I want to kind of bounce it back to you and let you ask some questions on that.
Well, yeah. So as we get into that, I think so. How I was trained. This is back. Man, I graduated so long ago. This back in like '02 maybe. '01 I think is when I was started to train on this. But the whole idea, and I don't know if the industry's changed too much, was that again, this is different from how you're operating, but the traditional personal, like if I'm coming in for finance and I'm like a typical household, what the person's going to say on the consulting side or whatever is like, first of all, you need life insurance because if you die or whatever, everyone needs to be protected. So, like, obviously, if I died right now, I don't want my wife and kids to not be able to pay the mortgage. And then, of course, the pitch is, well, you need like way more coverage because, like, like you want to pay off the house, pay this off, send your loved one on a cruise, whatever. It's like, so I always felt like I was being oversold. But anyway, there was like the term versus the whole life. I worked at a firm that did mostly term and said invest the difference, but like the whole life idea was that there's something there at the end. And then I've been seeing a lot like on children, which I don't like as much because I think the idea is obviously it's like the odds game or actuary, like you're betting on them passing away versus I'd rather have all that money going into an investment. But again, that's something my mom, when she went to an advisor, was trying to get on grandkids and stuff. And I was like, don't do that. I'd rather have you betting on their future. Anyway, there's the life insurance side, like like a business. They're going to guard against risk. So like they can LLC, but then they can also get insurances and stuff. Then usually the next tier is you do like the emergency fund. This is like Dave Ramsey just taps into the basics, like, from what I've seen anyway. So, emergency fund. So again, if you have an unexpected expense, you have X amount of dollars, let's say it's 3 months salary saved up. Then it goes up into like you're investing for the future and so on. Is that how a lot of firms still work? And usually the number one thing they want to sell you is life insurance because there's a commission. But then generally speaking, mutual funds are the most common for your retirement. And then of course the emergency fund would be like a money market. And then I'm probably missing some things, but is that kind of how the industry works right now? And I see the person selling, sorry, I keep going, but I see the person working like how HR, are they there for the employee or the company? Well, generally speaking, it's really for the company. I see most financial companies, are they really there for the investor or the company? I'd say company over investor, but not that they're not like against the investor, but obviously they're biased towards the company and their loads or whatever. So anyway, let me know what you think on all of that.
There's a lot to dive into there, really. Let's talk about the insurance a little bit. When you're sitting across from an advisor where their primary compensation comes from selling you an insurance product, they're absolutely going to say you need insurance and you need as much of it as you can afford. And I said this to somebody the other day. I said, you can't really hold it against them when that's how they make money and that's how they cover their livelihood. But at the same time, I see a lot of advisors or glorified insurance salespeople, really, where they say, hey, you need this insurance. Yes, I get compensated from it. but I really feel like I'm making a difference here, right? I'm helping you in your life. Well, good intentions are, there's more to that, I think. But um, where I see insurance being missold is sitting across from a client who doesn't have any dependents, they don't have a spouse, they don't have any kids, they don't have that real need for the insurance, and I see a lot of insurance getting sold there, especially whole life policies, because whole life policies can be pitched as a savings tool. Um, and there's a lot of talk of be your own bank and the infinite banking premise. And so the
And
idea, go
well,
ahead.
I want to say real quick, when I was in college, the company I worked for had me buy my own policy, and I was in college and I owned nothing. I
Yeah,
didn't even have a net worth, and that's why I couldn't do mortgages. I'm like, I don't own anything because I'm a broke college kid, and so you had to be worth so much. I can't remember what it was at the time, 50,000 net worth or something. I'm like, I don't own anything. I'm a college kid. And they're like, well, at least buy life insurance, and I'm like, there's nothing to insure. So I see what you're saying there. That
yeah,
makes a lot of sense. Oh, so sorry to
yeah.
interrupt you, but keep going.
No. You're good. You're good. I love the dialogue. Yeah, I see it happen often where insurance is sort of used as the foundation, and I think a lot of different advisors could argue like where do you start and what's the foundation. Some use insurance, some say it's the investment, some say you need to start with your emergency fund, right? It's sort of a philosophy, and so whether one is right or wrong, I don't know if I can say that. But when somebody is getting insured, yes, but they don't have any assets, they don't have any real need for the insurance, that doesn't always make sense to me. Um, and also, back to the infinite banking premise and building whole life as a cash value policy, it's basically verbally it said this can be a savings account for you, and you have the option to throw a large chunk of money in here, and eventually you can borrow against it with a lower interest rate than if you were to go borrow from a bank or a private lender. But those policies are not actually, rarely do I see them actually designed to serve that purpose. They're really designed so that the person selling it gets the highest commission possible. And it takes a long time, years on years on years, for the cash value to build up to be a significant amount to do something. So it's a really shady side of the industry. And right here is where I want to say, can whole life insurance make sense for a client? Yes, it can, but it's not, you shouldn't lead into the conversation with, hey, I have a great product for you. You should lead with what are your goals? What are your needs? And then create a solution to help satisfy those. Um,
Well,
and
and
so,
I think
go ahead.
circular investing too, because even term life, you're circular monthly or quarterly paying in. So you make a sale once and it keeps going. So I like that idea. But of course, term expires. Once I turned 40, of course, my premiums went up because I'm more likely to die. Um, which is, I mean, we're talking life insurance, so it's sad but true. And
Yeah,
so my premiums went up, and then at some point they'll expire, just like me. But they'll expire hopefully before me because they're betting on that. So some could say, well, term life is really like you're gambling on dying young. But like I get the idea of buy term, invest the difference on your own. That was one of the phrases where some will say buy whole life and it's got an investment. And if you're thinking circular, basically you pay on it till you go. So like my term expires at 65, whole life I would keep paying indefinitely. The company would make circular money basically until I actually die. So um from a sales perspective, it makes sense to sell the whole first because it's like indefinite almost.
yeah,
Term though, you could argue, well, you are betting they are betting that you'll live past it so they don't have to pay it out. So I guess you could
sure.
say, yeah, there's all of these odds there that are, I don't know. I don't, what do you want to do with that? Go ahead.
Well, I want to talk about risk management. So risk management is a part of the CFP process and is a part of financial planning. Really, when people hear risk management, they immediately go to insurance, and that's the way it's just described in the industry. But risk management is really assessing everything and understanding, do you want to transfer risk, which means you're buying insurance, right, to cover. And that's health insurance, that's life insurance, that's disability insurance, that's everything. Um, but also you can choose to retain that risk, which means, you don't buy any life insurance. And so then you are sort of gambling in that regard of, how long are you going to live? But the general idea, I think, with term insurance is, let's say you buy a 30-year policy at age 30, as long as you continue to pay the premiums, you'll have that until you turn 60. The idea with term insurance is that you will continue to build assets. You're going to continue to work and build up cash, and you're going to invest, and you're probably going to have real estate at least your primary residence. And so the idea at 60 is that you would have enough assets, you would be debt free, that those assets would be able to cover if you were to pass away at age 60. Those are able to be passed on to your beneficiaries. A lot of people look at term insurance, they feel like they're sort of wasting their money because, yeah, what happens when you hit age 60 and then, you don't have it anymore? But it's a process. If you're going to purchase that, you have to know that, your plan now is to start building up your assets in whatever way possible. A lot of term insurance will have a convertibility rider, which means you can convert it to a whole life policy at any point. Some people will do that with legacy in mind, and so then they start. They know that there's going to be a permanent death benefit there for when they pass away, as well as that ability to build up a cash value that they can use if they want. So sometimes that can make sense. But yeah, risk management is really about understanding, like, do you want to transfer that risk to somebody else, the insurance company? And as far as determining the dollar amount for your death benefit, this is the other thing I see a lot of, which is you sit across from the insurance salesperson and they say, let's look at your cash flow. Well, you have $200 a month that you could put towards insurance, and that means you can buy this much of a death benefit. Well, I don't think that's really the best way to approach it, because that you're really just trying to sell them the biggest product you can. The questions that you should be asking are, what do I want this insurance to do if I passed away? Do I want it to pay off my house? Do I want it to allow my spouse to not have to work for 2 years or 3 years? Do I want them to be able, you joked about the cruise. Do I want my spouse to be able to, travel the world and go on a cruise?
I'm
Do
planning
I
on
want
my
to,
remarrying within 6 months. That's how I did
right.
mine.
Yeah, exactly. Do I want it to pay for my kids' college education? If those are things you don't want to do with that money, then um, maybe you just said, hey, I want insurance to be able to cover my funeral costs, $30,000. Well, then buy a policy that covers $30,000, right? Don't pay for the additional if you don't want that money. You don't have a purpose for it to serve when you pass away. Um, and so I prefer to lead from the, what's the need, and then start calculating what that amount is. Maybe it ends up being $1 million. Maybe it's 2 million. Maybe it's 500,000. But you shouldn't just say, hey, you can afford $2 million, go and buy this. Because I think that cash flow could be used in other ways. Maybe it could be invested. It could be used to live on, which I want to address that later.
Well, yeah, I was gonna say let's transition now from the life side to like, and then we can get into what you do versus how a typical person does it. So now let's say we're getting into like the emergency fund. So
Yeah.
usually the advice is put it in a money market or something that'll beat inflation, which is not guaranteed, obviously as of late. Right now it's beating inflation, but maybe by 1% or something. But again, it's anyway. And of course, a savings account's always going to lose to inflation. It hardly makes anything. If you had deflation, which is I don't know if I've ever seen that. That would be actually you usually don't even consider that, but just you're usually trying to hedge against inflation. So you want your money, you're putting it in an emergency fund. Let's say it's for a rainy day. You want at least the money sitting there to be outpacing inflation, and
Mhm.
then the next thing would be retirement. So both of those are investments. I don't know which licenses, like which series people are getting these days and those kind of things, but generally speaking, The person will then, the consultant or whatever, will get into, and they'll get into mortgages and stuff, but we'll leave that to the side for now. Generally speaking, you got risk management, and then I guess emergency fund, which is kind of risk
Mhm.
management, and then retirement. So, and then most
Yeah.
retirement, I would say, is mutual funds. So, let's get into those two. So, we got emergency fund and mutual funds. How do those typically work, and then how do you differ in your approach?
Yeah. So emergency fund is definitely, I would put that in the risk management section. And Dave Ramsey says, right, build up $1,000, and then eventually, I forget what step it is, but you get to where you save 3 to 6 months of living expenses. And this is another thing you'll find, that I'm not an absolutist really on anything in any direction, because some advisors would say, if you're married, if you have kids, a dual income household, then you should have 6 months of living expenses saved up. If you're single with no dependents, then you should have 3 months saved up. But again, I think it's based on the need. I think it's based on risk tolerance. So some people like to see a couple extra months in their bank account. And I think there is a lot of value to having cash. Uh, I do believe you should be putting it in a high yield savings or a money market, putting it somewhere where it's liquid, it's flexible for you to get to. But it is outpacing inflation. I think that's a big goal. Um, but a lot of people get a little antsy about having too much cash, and they want to throw that into business opportunities or throw it all into their investments. Well, then they are subjecting themselves to a new risk, which is lack of liquidity. So when I'm talking to a client and they say, I want to buy a house in the next 1 to 2 years, then we start having the conversation about how much cash do you need to have saved up? What kind of down payment do you want to make? We may need to back off putting some money into retirement savings because you need to have it accessible. So yes, there is a lot of value to having cash and having it handy. But also a lot of people like to hold all that cash in their checking account that earns zero interest. That's a mistake. So yeah, as
The
far as
bank likes
emergency,
it. The
yeah, the
bank
bank
likes it
loves
because
it.
they're
Yeah.
investing it or
Yeah,
whatever.
the bank is a business, and they want your money just like the insurance salesman sitting across from you. They want your money. So when you understand that, most everything is a business that's trying to grow and make money, then you get a sort of a fresh perspective on things. But yeah, as far as that emergency fund, I don't really have that one rule of thumb that I stick to. I mean, if I had to say something, it would be have one, right? Have an emergency fund, but it just depends on the client and what their need looks like, what their risk tolerance is to, you know. And I was talking with a client, and he said, "Hey, I'm willing to spend most of my emergency fund to make my down payment on my house, and then I'll build my savings back up after that." And I said, "If that's what you're comfortable with, go and do it. Just know that you are creating risk over those next few months. What if you lose your job? What if your car breaks down? There's a lot of scenarios. So that's about emergency fund and cash. Now, regarding mutual funds and regarding investments, and we can circle back to the cash or the emergency fund if you got more on that. But um, mutual funds, generally, that most are going to have a sales charge, and they incentivize the financial advisors that are selling them to put more money there. And that could look like a sales trip or a bonus, or there's a lot of different incentives there that does inherently create a conflict of interest. Um, but why put your money into a mutual fund that charges 5.5% upfront every time you buy more shares of it? It also charges an expense ratio annually, let's say 0.8%, when you could go get a no load ETF, exchange traded fund, and maybe you pay, if you go with Vanguard, they just lowered their fees again. Maybe you pay 0.1% or 0.2% annually to put your money into an ETF that is comprised of multiple stock holdings and potentially fixed income. So the mutual fund companies, they offer break points, which means if you put so much money there, then the expense ratios will drop, maybe the sales charge drops, but you have to put pretty significant amounts of money in those. Um, to be able to interact with mutual funds, usually it's the Series 6. A lot of broker dealer registered representatives, you'll see that they have a Series 6, Series 63, Series 66. Um, for a registered investment advisor, and what I am, I only have my Series 65, which allows me to give investment advice. But typically, yeah, I don't use mutual funds with my clients. I'm designing portfolios based on individual securities holdings and based on ETFs, because the fees are much smaller. Very significant difference. So mutual funds are sort of the old school way of thinking, to be honest. And ETFs came in the picture in 1993 and have started to rise in popularity. Um, and ETFs can cover a lot of different areas. You could go buy an ETF that focuses on precious metals. You can buy ETFs that are REITs, that's REIT, real estate investment trust. You could buy an ETF that mimics the S&P 500 or the Dow Jones. There's so many options out there. But ETFs are what I believe the way to go, as well as concentrating sometimes into individual stocks and
Well, I think
companies.
too, a lot of it, employers for whatever reason are just sold on these mutual funds. And I think back in the day when I was, again, I was like early 2000s. You were saying ETFs were before that, but generally speaking, it was like not well known. Obviously, internet and all of that, the way we have it now, accessible like on our, our phones or wrists or what have you, wristwatches or whatever. Um, or smartwatches. Wristwatch sounds kind of old school, but generally speaking, like you didn't really hear about ETFs much. It was just kind of like, oh yeah, like it was still like you were letting other people plan for you, and generally speaking, businesses gobbled these up, and that's what they're still doing. So
Yeah,
of course the trade-off is if your employer matches you, that can offset the fees.
yeah.
Um, so that's the one thing. If you're doing it on your own, a straight mutual fund, I almost don't know if that makes sense to eat all those fees versus if your employer is matching. But ETFs, I'd say ETFs, they're pretty much a stock that acts like a mutual fund, right?
Yes. That's a good way to look at it. And I want to pivot so I don't lose this thought. So we're talking about employer sponsored plans. So if your employer provides a 401k or a 403b, um, typically within those, there will be an option to go buy a mutual fund, or there might be options to get ETFs. And so typically you're looking for whatever has, the lowest fees. You're probably going to pay that 401k administrator like an annual, operating expense. But that's fine because they're handling the rebalancing of your portfolio and managing it and handling all the tax documents for that. So that fee, in my mind, is fine. Um, but yeah, to be clear, yeah, a mutual fund is a holding within an account. So um, if the 401k only offers the mutual funds, then that is what you have to use. And I am a big proponent of investing in your employer sponsored plan. A lot of advisors, because they're trying to gather assets, because that's how they get paid, they want to try to get your money out of that employer plan. But if you have the potential to put, say, 7% of your paycheck in per month, and you get a 7% match from the company, that's guaranteed money. I don't really like to say free money because you are working to earn that benefit, but it is guaranteed money. That's a 100% return that can't be matched anywhere else. Um, so there's a lot of incentive to put money into your employer sponsored plan. And if mutual funds are the only options, then that's what you go with. But usually in most employer sponsored plans, you can go with ETFs as an option. And some of those uh, plans will also allow you to buy individual stocks as well, which, there's more exposure, there's more risk there, but sometimes it does make sense to concentrate. Let's refer to Eastman Chemical Company. They offer, I believe they offer an incentive, a discounted price to buy shares of Eastman. Or State of Franklin Healthcare Associates offers an ESOP plan, which means you're getting shares of the company for years of service. That's great if the company does well, but that means you also have a heavy concentration, of your investments, your retirement in that company. And so at some point you probably want to sell some of those and diversify, but that's a rabbit trail. So
Well, I do
yeah,
like the idea of ESOP too. If a company can do that, I'm not sure you have to be worth millions or something for that to work, but and of course, like how the stock is, issued and all of that. It's like for not most small businesses aren't going to be able to do that, but
no,
yeah. So, but I do like that idea, and that's a lot. That's pretty much how, or at least a part of how CEOs are compensated. Cheap stock or whatever. But I do like the ESOP idea. So I guess what would you say as far as okay? So I'm like, let's say I'm I don't know 25, and I come out. I just started working. I come out of college, and I've been working a couple years. I'm starting a fam, and my employer, let's say that they're a small business, so they're trying to offer me a few things, but they're not great. And then, of course, we didn't even talk about health insurance, but we're just going to assume that's covered by the employer, even though I know that's not the norm. But
sure.
what should I do in general, or what should I be concerned about if I go see an investment advisor that's not like that doesn't use your model?
Yeah. Well, yeah, I mean, this is where all the nuances play in. And so it's always like the answer is, well, it depends, right? Which is people don't want to hear it depends. But yeah, I think, at 25, you're starting out, maybe you're a couple years into your career there, and yeah, you're starting a family. If you're going to sit down with a financial advisor, you need to know, what their insurance stance is. You need to understand how they're compensated. Um, I think you should be asking, are they a fiduciary, and do they have your best interest in mind? Um, and so when you get the answers to those questions on the front end, that can help determine if they're the right advisor to work with. I think you should also be looking into, you should look at personality, really. Is it somebody that you could see yourself, are they trustworthy? Can you see yourself talking with them and engaging with them on an ongoing basis? I think those are important factors. But if they start the conversation off with you and in the first 10 minutes, they've asked you how much money you make, and they're already starting to talk about products, red flag, right? That's something that that you shouldn't be at that point yet. They should be asking you what your goals are. They should be asking you about your family. There are a lot of factors that you have to gather that first before you can really start talking about what a solution is, for that client. So um, the other thing is, if you're starting out and you're going and sitting down and talking with an advisor, um, what a lot of people, the average consumer, the client, doesn't know is that you can search for that registered representative or that advisor. You can search their name on a resource called Advisor Check. So every financial advisor, if they're interacting with securities and providing investment advice, they'll be on there, and you can find their name, and it will show what licenses they have. It will show where they're licensed to operate, what states. Are they registered just with the state, or are they registered with the SEC? And it will also show any red flag disclosures. So I'm going to use myself as an example. If you're going to sit down and work with me and something seems off, and you look my name up and it says that I've had 3 infractions over the last 10 years where I sold unregistered securities to my clients, or where I sold an annuity and I promised certain things about that annuity, and you as the client disagreed or you felt like you were taken advantage of, those things get reported and it stays. It is a permanent report card. And so those things are there. So if you look those things up, are you going to work with me after that? You might, but it also might bring up new questions. And so those are the things that I think that consumers should be looking at. It shouldn't just be a 10-minute conversation. Okay, I'm ready to work with you. Let's go. I think, look in, dig in, ask more questions, get an understanding of what that relationship's going to look like.
Yeah, and I'm not really sure too, like what the major players are. I mean, I know there's like Northwest Mutual and some of those other ones, but I know a lot of I'm not even sure who's like the personal finance side. Who are the big ones that are kind of popular right now?
So there are broker dealers, which is usually the side that I was talking about early on. And I told you I don't hold my punches. So if they're working for a broker dealer, there are going to be sales agendas being pushed from top down. But Northwestern Mutual, Western and Southern, New York Life, those are some of the big guys where typically they get their insurance licenses and that's where they sort of start out. That's how they're making their money initially. Then they go past the other securities tests to where they can start providing investment advice as well. Not a big fan of Northwestern Mutual specifically. Most of the time, most of their agents don't get their securities licenses at all. They start out just doing insurance. And if you ever are going to set up an account with them to do investing, they're going to go through a senior person that can help you get set up. And then when that agent statistically doesn't make it, it's a very high probability that they don't make it past a year. You then get handed off to that senior advisor or somebody else that you have no relationship with. And you probably won't get contacted very often about the status of your investments or about your insurance. So yeah, not a big fan of them. You've got sort of an in between, like an Edward Jones. So you probably see a lot of Edward Jones financial advisors. They're a little more of the in between. They're not as bad as what I just described, but they have incentives to open accounts with you and to get assets. And you may not hear from them often as well. Just onboarded a client recently that had a Roth IRA, about $13,000 in there. $8,000 was sitting in cash in her Roth IRA, and the rest was invested. And so she's getting charged an annual account fee, as well as every time she buys shares, there's a sales charge there because it was mutual funds. But when I tell my client I'm managing their investments and then I'm holding all their money in cash, that's wrong. So there are a lot of I want to be clear. There are a lot of great people I know that work for Edward Jones. There are plenty of good people out there that work for Northwestern Mutual. Same for New York Life. But I do believe that to go and work for those companies, there are agendas that are pushed down that then get pushed onto the clients. So that's what the broker dealer side looks like. Now you have the other side, which would be RIAs, like how my firm is set up. And you can go work for a larger RIA and just be an advisor, or you could be a business owner and go launch your own, which is the route that I chose to take. RIAs are always going to be fiduciaries. Doesn't necessarily mean they're always fee only. So they could be fee based. They may sell insurance, but the key is how transparent are they about their pricing? Do they disclose that if they provide a recommendation for insurance, do they get paid for it? And if the client has seen that disclosure and they understand and they say, yes, I still want this insurance and I want to buy it from you, it's good. There's no issues with that. But I very strongly believe in transparency. I always want my clients to know what they're going to be paying. And if I'm going to send them somewhere to get insurance, I want them to know that I am not getting any kickback from doing that. but yeah, so you've got the RIA side, you've got broker dealers, and this side's usually a little more sales oriented, and I believe RIAs are usually more relationship oriented, and creating solutions based on the situation and the needs.
So would a typical IRA then kind of I don't know how exactly how yours works, but like I would imagine then you have relationships with certain vendors, if you will, but you don't actually sell their things, and you would charge basically a fee just for. So I would come to you and I'd be like, hey, I don't know where to put my money. You would charge the fee for helping me decide where it should go, but then I'm either finding my own companies or you're recommending some to me. Am I right or wrong?
Yeah, from the investment side, so the major custodians where advisors store their clients' money would be Charles Schwab, Fidelity, Altruist is the number three in the space, and they're growing rapidly. That's who I use as my custodian. So they have models that they've created that you could put clients' assets into. But on their platform, I also have access to Fidelity's funds, to Schwab's funds, and a lot of smaller portfolio managers that have different niches and different objectives. And so when the client says, here, manage my assets, they're giving me the discretion to choose the best fit for their portfolio. And so sometimes I use altruist models. Sometimes I do Schwab. Sometimes I'll have some individual holdings. But what ties everything together is understanding that client's risk tolerance, understanding what their time horizon is for when they need access to that money. If the client is 25 and they're not retiring they don't plan to retire for 50 years, well, we're probably going to go a little more aggressive if their risk tolerance allows for it, right? We're going to be primarily in equities. We may not have a lot of fixed income bonds and cash equivalents. But again, it's situation based. So the client could be very risk averse. So we might have some fixed income in the mix there. But yeah, to use altruist models or Schwab or Fidelity, they don't pay me anything to use that. There are no kickbacks, there's no commissions. But yes, the client is paying me for my knowledge and then for my discretionary management of their assets.
All right, so well, thanks a lot, Matthew. How can interested parties get a hold of you if they're looking for more financial advice?
Yeah, absolutely. So my number, I give my number out, people can text or call. So my number is 423-268-0973. You can also send an email to Matthew at planwithvalor.com. And I do have a website that is it's in process right now and should be live very soon. And that would be planwithvalor.com. And so I'll have a link on there for people to book a 30-minute intro call with me, as well as I can share other links for additional time. But yeah, I'd love the opportunity to sit down and talk with people, share more, about my stance on the industry and how I work with clients in a different way.